Now, like I said in one of my previous videos, the US stock market is a bit overvalued. Well, actually, it's in a full-on bubble. However, there are still stocks out there that I would consider cheap. And so today, we are going to look at 5 stocks that are cheap in my opinion, and I'm currently buying them. So, let's get into it. Now, the first company we are going to look at is Genpact. This is an American information technology services consulting and outsourcing company headquartered in New York City, New York. It was founded in 1997 as a unit of General Electric, but quite quickly it outgrew its parent company and started to expand, eventually going its own way and listing on the Nasdaq in 2007. Now, there are a number of reasons why I like this company a lot. One of the main reasons is that they're incredibly diversified in a lot of ways. If you go to Guru Focus, amazing website by the way, you can see that they are getting most of their revenue, all of their revenue, from 3 different sectors: consumer and healthcare, financial services, and high-tech and manufacturing. So there's a good amount of diversification when it comes to the different sectors that they're in, making them quite resilient. And the same can be seen if you look at region. Even though a majority of the income is from India, they also get a lot of their money from North America, Europe, and other Asian countries. And to be honest, 58% India isn't necessarily a bad thing, because it is projected that India will have amazing economic growth in the future due to strong population growth, which a lot of other developed countries are actually lacking. So having a strong footing, a strong position in India is actually a very good thing. Meanwhile, if you look at their ROIC, their return on invested capital, you can see that it has been between 10% and 16% for basically more than a decade at this point. And to be honest, they've been doing incredibly well since 1997 when this subdivision of General Electric first started and eventually grew to its entirely its own thing, really. Meanwhile, if you look at all the other metrics, like their steady revenue and net income growth, as well as their cash to debt balance, you can see that the company is actually incredibly healthy. Even the current ratio is 1.5. Anything above 1 is fantastic. It's great. So really, even financially, they're incredibly strong. Now, if you look at the fair value of this company, you can see that it comes out to around $67 to $89, depending on the method of valuation. For example, discounted cash flow using free cash flow comes out to around $67, as you can see here on Guru Focus. You can also do this calculation by hand, but overall Guru Focus is really good at it, so I usually use them as a bit of a benchmark. I even look at Yahoo Finance and Simply Wall Street for a lot of my valuation stuff, aside from my own calculations, because you need to get like a wide basket of different valuations in order to get an idea if it's truly cheap. Not only your own valuation, your own calculation. Another calculation I like to use in order to get an idea of its value is the intrinsic value calculator, which was created by Benjamin Graham, legendary investor. If you use this one and you put in the expected growth, which I put at 12%, which is around the average of 10 to 16, slightly more pessimistic, and I used a corporate bond yield of 5% because I looked up their debt and they have a BBB minus rating, which means that their average debt burden will be around 5%, like the interest they pay on the outstanding debt they have. Then you come out to around $89. So I would say that this company is somewhere in between the $67 to $89 range, depending on how enthusiastic you are and how bullish you are and how much risk you're willing to take to try and hit the top end of this valuation. And even if you go to other analysts, for example, on Yahoo Finance, you can see that they value it at $42 to $58. Even if you use the analyst price targets, which is based on, I think, how many different analysts? 11. Even if you use that data, then Genpact is still quite cheap. And the company is also jumping on the entire AI wave, as you can see from their website, where they're using AI agents in a lot of their business solutions. Overall, I would say that Genpact is actually a pretty good bet. A decent one to take. But let's look at the other 4. Now the next company we are going to look at is Qualcomm, which is a bit of a surprising one because Qualcomm is actually a tech company. And as we all know, there are a lot of overvalued tech companies at the moment due to the AI bubble. But for some reason, Qualcomm is actually quite cheap. Now, Qualcomm is an American multinational corporation headquartered in San Diego, California, and incorporated in Delaware. It focuses on creating semiconductors, software, and services related to wireless technology. It owns patents critical to the 5G, 4G, CDMA 2000, TD, SCDMA, and WCDMA mobile communication standards, and almost everyone owns devices using their chips because they play a massive role in the smartphone market. And now they also want to enter the world of AI. Now overall, Qualcomm is an incredibly strong company with a strong foothold in the smartphone market, both in the communications as well as the chips, and even in the world of Internet of Things and self-driving cars. So think about your Google Home, your alarm system, or the chip that your car uses to, for example, do functions like lane assist. They have an incredibly dominant position in all these sectors. Now, aside from their overall position in the market, which I like a lot, they also have incredible financials. If you go to Guru Focus and look at their ROIC, you can see that it usually ranges from 15% all the way to 43%. Which is crazy, but very fitting for a tech company. A lot of tech companies have growth that ranges, that's somewhere in between 20 to 30%. Really, tech companies are some of the best to invest in. There's a reason why they're kind of overvalued, and they have been pretty expensive for a long time because they're one of the best picks in the market. It makes sense. Meanwhile, if you look at their balance sheet, you can see that they have a current ratio of 2.82, which is fantastic, and even a cash ratio of 1.11, which is also absolutely nuts. Now, they had a bit of a dip during 2022 and 2023 around this time, but to be honest, this makes a lot of sense because a lot of companies experienced rough times and a bit of a dip, but that makes sense because a lot of companies experienced some rough times during those 2 years, 2022, 2023, mostly due to the Federal Reserve, the Central Bank of America, increasing interest rates, making borrowing more expensive, and also doing things like QT, quantitative tightening, which basically takes money out of the economy, which slows it down. So it makes sense that Qualcomm has struggled a little bit due to that. However, as you can see, they're on the way up again, which is a good sign. Meanwhile, if you look at their global diversification, you can see that they are pretty well diversified. South Korea, US, and China are like their biggest markets. The only problem I could potentially foresee is that China becomes a bit of a problem due to tariffs. If Trump gets in between Qualcomm and San Diego and China, this could be a bit of an issue. It is a gigantic market for them after all. So while I think Qualcomm is a good investment, you need to adjust your position sizing to make sure you're not over-invested in Qualcomm. But in general, I would say that investing a maximum of 8%, more like 6%, per position in your portfolio is a good way to diversify, and having at least 20 to 25 different positions. That's what I do at least. Anything beyond that, if you have like 300 stocks, which you all put like 0.25% in or whatever, then you're over diversified. You might as well buy ETFs because you're just going to perform almost equally to the S&P 500 or potentially even worse. So there is over diversification and under diversification. Yes, I invest in it. Yes, I have shares in it at the moment as we speak, but don't over-invest. Keep this risk of China being a massive market for them in mind. And the same actually goes for Qualcomm's smartphone share, their market share, because both Apple and Samsung are moving away from Qualcomm products like the Snapdragon and want to develop their own chips because Qualcomm is taking a massive cut. Now, this will take a couple of years before they're able to actually completely replace Qualcomm, and there's even a chance they'll never really get there because Qualcomm has so many vital chips and vital patents and architecture and software, etc. So there's even a decent chance that they won't get there, but still, it is something to keep in mind. However, there are certain regions where Qualcomm has a lot of potential for growth. For example, if you look at their recent financials, you can see that automotive and Internet of Things is actually delivering pretty great growth. For example, if you look at their financial summary for 2025 Q4, you can see that automotive and Internet of Things is growing quite rapidly and is becoming a bigger and bigger and bigger share of their total revenue. So while they might lose smartphone market share, which is not even a given, they are expanding their business in a way which is incredibly profitable. Like self-driving cars and smart homes and smart devices are an incredible market to move into because we can see a lot of growth there. So that makes me very optimistic. And in general, they already have a great position in the market when it comes to tech anyway. Now again, when it comes to fair value, we have to place it somewhere between $268 and $350 depending on the method. With $268 for free cash flow, discounted cash flow calculation, and for the intrinsic value calculation, I came out to $350. That makes the stock in general at 163 incredibly cheap. And even if you compare it to analyst price targets here on Yahoo Finance, and again also on platforms like Simply Wall Street, you can see that the stock is incredibly cheap because they expect a minimum of 157 and a maximum of 225. So the current price of 164 is a bargain. But again, with the fact that China is a big market for this company and Samsung and Apple are moving away from Qualcomm, potentially, if they succeed, we do have to watch out when investing into Qualcomm. I do think it's a cheap company. I think it's a fantastic company. I think it's worth buying, but don't put 20% of your portfolio into just Qualcomm. A maximum of 5% should do. Now let's look at the other three. Now the next company we are going to look at is Adobe, which is a fantastic company to invest in. It is the king of the creative industry. But for some reason, even though they have also been investing in AI, everyone is ignoring them. Now, Adobe is near and dear to my heart. For years, I've worked in the creative fields as a YouTuber, and this company focuses on running and creating software for all kinds of digital products like photos, videos, animations, and much more. They are the undisputed king and have held a monopoly in this field for more than 20 years. Everyone knows about Photoshop, Premiere, Acrobat, After Effects, InDesign, and other programs. But many expect the company to do worse due to AI. However, there are no signs of this at all, with the company beating earnings again and again. And they are also integrating amazing AI tools into their own products. For example, generative fill. Now, one of my main reasons for investing in this company is because it's a natural monopoly. Everybody uses Adobe software, and there's a reason for it. Because everything else out there is just not good enough. Really. People have been complaining about Adobe for years and years and their pricing sucks and this, that, and the other. But they've only gained more people. They've only gained more memberships, more clientele. And nobody I know that has said for decades at this point, oh, Adobe sucks. I want to get out of this. Blah, blah, blah. None of them left. They all still use it. It's fantastic in my opinion. It makes me smile every time. And that's one of the main reasons why I want to get shares of this company, especially now that it's so ridiculously cheap. Now, just like every tech company, AI makes crazy money. They have more cash than debt. Their growth has been crazy to say the least. For example, here you can see that their ROIC is 25%. Return on invested capital is 25%. There are very few companies that can claim this or even get close to this. Their current ratio is above 1, so again, the finances are pretty good and they have more cash than debt. Although it seems like this has changed in the recent quarter, with a little bit more debt than cash, but still you can see every quarter they keep on growing consistently, profit margins or like the net income is under a little bit of pressure, but overall revenues keep growing and even net income has grown. Their profit margins are in general, to be honest, amazing, sitting around 30%, if I remember correctly. And even their most recent like quarterly return on invested capital have been above 25% consistently. And if you look at their diversification, yes, they do have a lot of market share in developed countries, but still fantastic. And as expected, digital media and experience are their biggest market. Creative Cloud is where all the money comes from. But so far, everybody has been screaming that AI is going to end Adobe. But it hasn't happened. They're still raking in more money quarter after quarter after quarter after quarter while integrating their own AI features like generative fill and others into their products, making sure they stay ahead of the game. And as somebody who has been in the creative industry for a long time, I've used a lot of the AI editors, and really stuff like Opus Clip, for example. They're not great. They're just not great. They kind of suck. They're decent at subtitles. They can do subtitling pretty well, as in like automated subtitles. But Adobe could do that as well. Like they could actually do that before those AI editors came out. Many of them were able to do it before that. Same goes for all kinds of other features like automatic rotoscoping, or really like Adobe has always been ahead of the game, and they most likely will be for the foreseeable future. And especially with the company being so low. Like their valuation peaked in 2024, then the tariffs hit, and they've only gone down since, and they're incredibly cheap. And again, cheap can become cheaper, but at the moment, it's still a great time to slowly buy in this position, a little bit at a time. Even Guru Focus is clearly showing that they're incredibly cheap, and even the discounted cash flow shows that it's $690, which is incredibly cheap. And if we use the intrinsic value calculation, you can see that the stock is stupid cheap, $800 discounted. Even if you go for a 20% growth, which would be low for Adobe, it would be a $680 company. So this is probably the one stock that I really don't understand why it's so cheap. With all the AI companies and in general big tech companies going up and up and up and up, I would have expected that Adobe would have done incredibly well for itself. But for some reason, everybody is ignoring this absolute gem of a company. And even many of the analysts expect the company to be valued between $280 to $605. I think out of all the companies on this list, this is one of the cheapest. So yeah, Adobe is certainly a great bet to get into right now. United Health, a company that has been struggling due to its CEO getting shot in the street, which was kind of crazy, and their profit margins going down due to inflation, putting a lot of pressure on their margins. But regardless of that, they are still an incredible company. This is a corporate giant that focuses on healthcare. It is the world's 7th largest company by revenue and the largest healthcare company by revenue. It is the largest health insurer in the United States, insuring over 50 million people, and operates globally. Its main focus is health insurance, but recently the company has been doing worse due to rising costs associated with a graying population and inflation. Their CEO was shot, and also legal issues with the US government. But all of these things are only temporary. They have a great position in the market, allowing them to raise their prices to protect their profit margins. This massive size gives them two advantages. Network effect, which makes them hard to get around. They're just such a big player you can't ignore them. And they're also able to deliver every healthcare related service to their customers, so why would they ever go to a competitor? And economies of scale. Because they're so big and they insure so many people, they have a lot of bargaining power, allowing them to get the best deal, the best pricing, the best margins. These things make United Health incredibly valuable. Now, if we look at their finances, we can see that they've been doing really well for themselves, growing at around 10 to 12% per year. The only real trouble that I'm seeing with their finances is that profit margins are lower than they used to be. And that's because of the graying population of America. more and more Americans are 60 plus, just old in general. We are seeing this in the Western world as well. A graying population is not a new term. It's something we have been adjusting to the last couple of years already. We can even see it in the labor market. So the only thing that United Health has to do, which they can certainly do, is increase prices. They need to recalculate and look at the situation, what they need to ask in terms of premiums in order to cover all the expenses and have around a 10% profit margin. So it's only a matter of time. And I'm not the only one who thinks this. Even Warren Buffett has bought United Health, which already shows that this company is undervalued, because usually Warren Buffett is right. The only thing that's a bit worrying is their current ratio. So that's something I will keep an eye on in the upcoming quarters to see if it improves. Now, when it comes to fair value, it is somewhere in between $430 and $480. Maybe $558 if we do earnings-based discounted cash flow. I haven't done this one myself, so I'm not sure if it makes sense. But I know this one, and the $480, I got that when using the intrinsic value calculator. Overall, the interest on their debt is fantastic because they have an A rating, which is very good. So they only pay 4.7%, so that was pretty low. It's easily worth around $450 to $500. And it's a very defensive company as well, so it's a great mix in a portfolio. If you have a lot of tech companies, buying a stock like United Health is actually great for diversification. And it even gives you a dividend, which is also a welcome sight. Even if you look at analyst valuations, you can see that they also expect it to go higher from here, but they're a bit more bearish than I am, which I kind of understand. There is a lot of pressure on their profit margins due to the graying population and inflation as a whole. But like I said before, they have the pricing power so they can adjust pricing, so they'll most likely bounce back. And at current prices, it's very attractive to add it to a portfolio. But I have one more stock left. Novo Nordisk, a company whose share price has fallen off a cliff, and it is one of the best opportunities I have seen in years. Everybody thinks Novo Nordisk is worthless for some reason, even though it is one of the biggest healthcare companies in the world. It is kind of crazy. Now, like I said, this is another healthcare company, but this one certainly has a monopoly, controlling around 70% of the obesity drug market and also a massive share of the new weight loss market. This Danish drug company is one of the biggest and most important in the world with a proven track record of more than 30 years of growth. But they are getting more heat from competition, which has hit their stock price. But the drop is insane because growth is still solid and demand for obesity and weight loss drugs will only rise due to the trend of more and more people becoming overweight. Even the World Health Organization agrees with that. Now, like I said, Novo Nordisk is a monopoly, basically. They are the biggest in the field. The only real rival they have is Eli Lilly. And if you look at Eli Lilly's valuations, they are incredibly expensive. And they're also dealing with a lot of fake medication, a lot of stuff trying to copy them, like copycat drugs. However, I expect these issues to be temporary. And even if Eli Lilly is able to get a bigger market share, Novo Nordisk will still be a massive player, and the amount of people who will need weight loss drugs or diabetes drugs or other medication they produce will continue to grow, just like the World Health Organization has said. I mean, people being overweight is on the rise, and it has been on the rise for 3 decades at this point. Even if we look at their finances, we can see that they're in a pretty fantastic spot. You can see that their share price has gone down from 145 to 47, which is a crazy dip, which takes a lot of risk off the table, a gigantic dip like this. And as you can see, even Guru Focus says it's stupid cheap, like no matter which kind of calculation you use, to be honest. And while the growth has slowed down a little bit, especially net income, this is only a temporary thing. Sure, there is a bit more competition, but again, the obesity market will continue to grow. And they're also taking on more debt and investing in America because that's a big market for them. And this investment also allows them to skip a lot of Trump's tariffs. Because like Trump has said, if you invest in America, you won't get hit. So that's another thing they're getting into, and I think it will pay off. It will hit their financials in the short term, together with pressure from Eli Lilly and copycat drugs, but in the long run, they will continue to see strong growth. Even when looking at the data from many different institutions like the World Health Organization, you can see that diabetes and the number of overweight people will only increase. The number of adults with diabetes grew from 200 million in 1990 to 828 million in 2022, according to the World Health Organization. And this will likely continue fueling growth for Novo Nordisk and companies like it. So again, while Novo Nordisk is experiencing a bit of a rough patch, this drop of 70% in share price is insane, especially if you compare it to earnings per share. Because while their earnings per share in the most recent quarter dropped, it only dropped by 22%. Meanwhile, its share price dropped by 70%. That already tells you what kind of mismatch, what kind of imbalance this is. So in general, I have also bought a lot of shares in Novo Nordisk, and I'm actually completely settled in. I can't really invest more into it because I don't have any more capital left in my portfolio and I don't want to over allocate. Again, around 5-6% maximum is what I'm aiming for per position. Diversification lowers your risk and also makes your portfolio a bit more steady instead of going all over the place. And as you can see from Guru Focus, it is stupid cheap. So I'm quite happy with my position. But even if you go to Yahoo Finance, you can see that many analysts expect a low of 43 and a high of 70. So even a lot of analysts think this company is undervalued. So yeah, I would say that this is another great company to invest in. And out of all the 5 companies that I listed in this video, that we covered in this video, I would say that Adobe and Novo Nordisk are probably the best bets. However, be sure to do your own homework. Don't just trust me, do your own homework, look at their financials, look at the company a bit. You can do this, I believe in you. It's not that hard, really it isn't. And I'm actually gonna make a video covering what I do to look at a company. Because my process overall is actually pretty simple and I don't overcomplicate it too much. The financials matter the most, to be honest, as well as its position in the market. I just covered these companies quite lightly in this video. I didn't really go super in depth because otherwise we're here for 300 hours. But yeah, I hope you enjoyed this video. Be sure to let me know in the comments what you want to see next and what you think about the 5 stocks that are listed. Do you agree? Do you disagree? And may the markets be with you.